and the numbers also showing you that we will get you more numbers in just a bit, but for now the numbers are disappointing.
Volume growth, I think, has come in around 6% or so. Mayuresh Joshi is online with us. Mayuresh, 1,060 on Unilever's PAT, 79.70 on the top line, and 6% volume growth. That's sub the ET Now estimates. What is your first take on the numbers?
Afternoon, Aisha. Clearly, I think the three numbers that you just enumerated, I think below expectations. On the profitability front, you're assuming a number in excess of 1,100 crores. Volume growth was expected to come close to 7%. And even on the top line, estimating numbers anywhere between 8,300 to 8,400. So yes, I think the disappointment has come through in terms of volume growth, which the street was closely monitoring.
Oh, yes. In fact, I think we have with us Gaurang Shah as well to talk about Unilever's performance. We will be joined with him in just seconds from now. But Mayuresh, the volume growth, that has come in sub our expectations at 6% odd. I mean, it's too early to really analyze what segments may have actually dented the volume performance. But what is your sense? What is not doing well for Unilever right now?
So clearly, if I do a segmental breakup for the past year itself, the soaps and detergent segment is where the volume growth has been the most minimal out of the four segments that it operates out of. Personal products has done reasonably well in the past few quarters at 6%. And again, beverages and processed foods, which forms around 20-21% of the overall top line, they've been growing decently as well. So I think soaps and detergents and personal products, which form bulk of the revenue, I think that is where the contentious issues might be. But again, I think one thing is also to be noted that with the kind of fall in raw material prices and input costs that we witnessed, I think price cuts have also been taken by HUL to protect market share. So I think one also needs to understand how the management is looking forward in that sense itself. But I think personal products is something that I'll be keenly watching out for. Soaps and detergent foods have actually benefited with PFAD and LAB prices actually going down, which would have aided their EBIT margin.
Mayuresh, in fact, stay with us. We're going to, in a few minutes, cut across to the management call as well and analyze what really went wrong with the volume growth this time. But Sanjay Manyal from ICICI as well is online with us. And we've also got Gaurang Shah to analyze Unilever's performance. But Sanjay, let me come to you first. The volumes have clearly disappointed. What, according to you, has dented in terms of a segment-wise performance for Unilever?
Well, as far as volume is concerned, it is more or less in line with what we were expecting, around 6%. The company has done 6% kind of volume growth last quarter also, so we were not expecting any huge improvement on that front. However, surprising is the margin improvement. What I understand, if I'm calculating the numbers correctly, it is approximately 18.9% kind of EBITDA margin, which is much higher than what we were expecting. It has seen approximately 150 to 180 basis point improvement. So though we were expecting, it seems that the management or the company has passed on some kind of a benefit of raw material cost, but the raw material benefit has been much more than that, and that's the reason why there has been such a huge improvement in the margins.
That's perhaps the only reason that you're seeing that 18.9% figure for the operating margins. But some comments as well from the management of Unilever saying that the phasing out of tax breaks as well as the price degrowth, that is what has hit the numbers in the Q1. But Sanjay, just to wanted to get in a call as to what you made of the higher advertising spends that perhaps countered the margin expansion going forward. And do you think that what do you make of these statements as well that have been given from the management with respect to price degrowth?
No, look, one has to understand whenever there has been a raw material benefit, FMCG companies generally have this trend that they pass on some kind of benefit. But I think, as I mentioned earlier, also the raw material benefit is much higher, approximately 380 basis improvement in the raw material cost, and obviously some probably increase would have been there in the A&P spend also, because generally this has been the trend that they pass on some benefit and they pass on some benefit in terms of A&P promotions or advertisement increase. But volume growth is 6%, and that's what we were expecting in our estimates also.
Gaurang, what has been your take? I mean, have you liked the numbers or have you not liked them? Because we're getting mixed reviews here.
Yeah, I think they are a mixed set of numbers, Aisha. But let us say, we did have unseasonal rains somewhere around about March or so. So possibly there is some amount of hit on the volume side that they would have taken. But guess post that there should be improvement now. It would be difficult to control ad spend in a very competitive environment. So the external factor is out of control. But I think internally, it remains to be seen what the management has to say in terms of commentary to, cut down costs to improve the margins. I think that would be something that one would be really, waiting to hear out from the management side. And what is their anticipation in terms of growth going forward from here on and the demand scenario from semi-urban and rural area? I guess this set of numbers should not really, bring any kind of downgrades if I say so. As a disclosure, we do have a positive coverage. Numbers are just coming out, so we just need some time to rework on the number. But from my side, I think there have been really a mixed set of numbers. Margins have been good. Volume, a slight, nothing great.
Gaurang, this is Gargi joining in from the research desk at ET Now. There was always a question in terms of how the rural slowdown is going to impact the numbers, and the portfolio which was basically focused on the rural side, that has not been performing well. Do you think that could be an added risk, and that in fact could be a negative side for the earnings in this quarter as well?
In the near term, Gargi, yes, it looks like, because there has been a concern. But like I said, there is improved visibility in terms of monsoon now and the additional expenditure that will be available at disposable for disposal from that part of semi-urban and rural India. So in the near term, that looks to be a little bit of sticky area wherein I think possibly you will have to spend more to garner much more market share and increase the volume growth from semi-urban and rural area. Near term, there could be a problem, like I said, but longer term, I think we still remain optimistic because we are quite sure that the input cost going forward from here on should possibly on the lower side, thereby there could be a case of margin improvement. And of course, innovations internally to cut cost and improve margins should also be put in place. I don't think that in FMCG case, like HUL is in, you can possibly do with advertisement, spend cuts or something like that, because you work in a very competitive environment.
Mayuresh, my next question is for you. In terms of valuations for HUL, do you think from these levels we will see a further upside? There are various factors, which are impacting. Some are negative. We have a very mixed set of numbers. Volumes, in fact, are possibly just about steady, while margins may have some amount of improvement expected. But overall, what do you think will be the most important factors for HUL for at least the next 6 months or so?
So clearly, Gargi, I think over the next few quarters, I think how the rural demand and the semi-urban demand shapes up amidst competition intensity is something to be watched out for. So I think the ad spends will be a key component going forward. Yes, I think the raw material costs are expected to stay benign, and that should have a positive rub-off effect. But again, I think to maintain market share or to keep their volume share intact, I think you will see price cuts initiated over a period of time. And again, I think the third thing that probably works against HUL is the valuations at the current levels. They're probably rich.
Resulted in price growth in commodity-led categories coming off. Overall competitive intensity continued to remain high.